Okay, so then we will just to recap what we have learned for the last 2 days, and then we discuss about the competitive forces affect our credit business, and then the credit analysis, and then we discuss impact of pre-COVID on economic and all other factors, especially the external factors for credit business. And what we are going to discuss today is the most important thing, and the impact of post-COVID-19 on credit businesses, right? And in fact, as we well aware about this, of by far the greatest and most complex impact of COVID-19 for banks will be on credit management, right? Okay, what are the things we are going to learn under this area? First, we try to identify the key risks for Sri Lanka, and then the de-riskings of the economy, what actions we have taken, banks, regulator, and government. And then we're going to discuss about what are the relief schemes proposed by the government and the central bank, and the most important things, the impact on banks. Right, these are the four key areas we are going to discuss in the today's. Then we emphasize more on impact on banks, where we are going to discuss a lot of practical issues and what are the pros and cons. That mean what are the advantages of this COVID-19 and what are the disadvantages. Okay, so these are the four areas we are going to cover next 2 hours, right? So as we know, so we discussed that also the last time also. So Delight has identified 4 potential avenues of adverse business impact, right? For maybe the disruption for supply chains, market disruptions in our market, psychology, right? All things have impact on business. And as we all are aware, so today the pandemic has left an unprecedented trial on both humanitarian and economic damage, and all countries need to be a balance between the human aspects as well as the economic aspects. So we need to balance it both. While if you are not looking after the people, and that's also very bad things, and the other side is to maintain the economic conditions of the country. So we have to be, it's like a seesaw, we have to balance it, right? So all people try to balance. Okay, so a lot of countries, a lot of administrators are, try to take some actions to curb the outbreak. Why? Because the economic downturn definitely impact our credit growth and as well as the credit growth and the credit quality. So what are the key risks for Sri Lanka of COVID-19? So we discuss in COVID-19 economy in Sri Lanka as well as the world. And we look at it, exports, tourism, remittances, supply chain disruptions, and also a little bit of external debt refinancing. So let's look at it. What are the key risk area for Sri Lanka post-COVID, that means after March? So as we all are aware, so mainly our SDFR and SLFR was brought down to 5.5 to 6.5, but we have changed for 6 times from 2019, right? And in fact, from January, we have changed 4 times. There will be a further reduction possible, right? And our overall fixed deficits going to be somewhere around 8.9 to 10.7, and our debt to GDP ratio going to go up from 86.8 to 93%. And what is our official reserves? Now, we started with 7.6, and there are some people, Morgan Stanley predicted go to 4.4 latter part of the year, and some people have suggested is something around 5.5 to 6 billion. So you know the importance and impact of gross official reserves for a country. But if you really look at the economy growth, and we have predicted earlier, I mean, before we started the year, maybe around 3.5 to 4%. But now central bank are now telling they may be accepted 1.5%. It's not a good thing, but still it's a fairly okay figure as far as the present condition is concerned. Right. So if you really look at the global economy, now you look at the world. So the world economy growth is -3. So we will discuss last time also. And then certain areas, maybe United States -6%, close to, and then Euro areas maybe -7. Middle East also contracted to 2.8%, and then we have Asia, of course, something's okay, but then Latin America and Sub-Saharan Africa, all except for emerging like developing Asia like China and all, some have some positive figure. Right now, if you really look at it, in G20 countries, they've estimated around 0.5. US is minus, of course, even China is around 3.73. And most of the countries where we are exporting our main items have a bad economic growth. That's the world situation. And then if you really look at it, the figures given by ADB, now if you have not taken any actions, the left hand side in your screen, they talk about estimated global and regional economic losses if you're not doing anything. Right, it's global is maybe as percentage wise in billion terms is around 8.7 trillion and 5.7, 8 trillions like that. So if you have done some measures, policy measures, we can reduce that up to from 9.74 from 9.7 to 5.9 globally, and Asia we can also end up with around 6.8 GDP loss. Right, these are some estimated figures, right? The ADB has identified because of this coronavirus. And then you noted that in 2008, the financial crisis, which took approximately around USD 22 trillion, that was estimated figure. Because of 2008 financial crisis, the world lost around 22 trillion. Now, what do you think about this figure? It's definitely more than that, right? And also we noted that significant decline in merchandise exports in last year as well. You know, our total percentage of export to USA is around 44%. So even though we are criticizing, but still there are a lot of that is the market for us, for our, especially for our apparel industry. And then if you really look at it, some figures in last year, the apparel exports is around almost 50% of our total export earning. That means if you think about our total export earning is around 11 million US dollars, 11 billion, 50% is contributed from apparel exports. And then the tourism business is around 3.6 billion, whereas the workers' remittance is 6.7 billion. So these are the areas, I mean, our income is basically, national income is consist of. Right. Now, if you really look at it, the workers' remittances, so we have up to April 2020, we had a decrease by 32%, and total figure is 2019 is 6.7 billion, right, US dollars. That's one of our main income source. And then if you really look at from the tourist arrivals, so 2019 of course 1.9, whereas the 2018.2.3. Why is this to 1.9? Because of Easter Sunday attack. And April, there won't be any person, right? And this is the situation as far the tourism and remittances are concerned. Now, if you really look at it, the first 3 months of 2020, the trade deficits widen. Why? Because we don't have any exports to other countries, right? And if you really look at it from export January to March, there is a decrease, and then from imports also decrease, but it's not corresponding uh, to the exports, right? Export is more than import, and therefore trade deficit also increase. Okay, so if you really look at it, the external debt refinancing, so we discuss is 86.8 to 93%, and we are expecting maybe around uh, maybe 400% maybe next year. But this is how our debt is consist of foreign and domestic. Right. Now, if you really look at it, this figure, so our foreign outstanding is around 6 to domestic to 6. So that is how in 2019 our total debt, right? It consists of domestics as well as the foreign is around 13 billion US dollars. Now, for local, so we issue in treasury bills and treasury bonds. Bonds 69% is local debt, and development bonds are not much, but majority of our local borrowing, so I mean the local debt is from treasury bonds. Right. If you really look at from the foreign debt, so 43% is represented the international sovereign bond. That's the US dollar term, right? And there may be a bilateral and multilateral and concerned interest rate amounts and high interest rate commercial loans we have taken, and that contributed like this. Okay, so why we need to put all these things? So we need to service all these debts. It is this 12 in 2019. So from the GDP is around 12.6%, right? And then if you really look at it, this year, how much of money we have to pay? Sri Lanka has to pay around US dollars 3 billion in debts, and one single day, that means in October, we have to pay around $1 billion. What is that? Is the maturing of international sovereign bond, and it is average 4.4 to 4.5 billion annually to be served over the 2025 period. So that means if you really look at it, the total figure is something comes to around 25 billion. So for the next 5 years, 25 billion US dollars we need to pay as debts, and from 2021 to 23 is US dollars 13.8. Now, how government going to do that? So government has already requested from IMF. They are given extended fund facility EFF, and a government was requesting to convert it to rapid financial facility, and that's the fund generated or initiated by IMF for COVID-19 affected countries, and our Sri Lanka is requesting convert this EFF to RFF, and they are requesting around US dollars 800 million. And we also got some syndicated loan US dollars 500 million from China Development Bank, and we are requesting to increase up to 1.2 billion in December 2020. If it is the case, we may manage to this year's debt, and also we arrange with the swaps with Reserve Bank of India around US dollar 400 million, and also we are requesting the swap facility from People's Bank of China around US dollars 1.2. Apart from that, so discussions are going with World Bank and Asian Infrastructure Investment Bank and Asian Franchise Developments. Those are multilateral institutions to give more lending facility for us. And this is something we need to know. Why? Because so Sri Lanka, we usually pay their dues at the correct time, and so that's the money going out from the country, right? So it's impacted the economy as well, right? Just to get an idea. Now, if you really look at it from credit to private sector, so we discussed last time at the previous session, the credit to the private sector was not good. Last time is around 4.6%. And then, but we have noted that there is a increase from Jan to March before this COVID happened. Right now, you see from the chart, there's upward trend. Right, then 4.3, and then it's gone up to 6.5%. But then after that, the central bank they thought, and this moment is not going to happen, and they have revised their um, targets. Now in 2020, instead of 12-13% growth, what they have expected in before, forecast 4% credit growth. And according to them, they said that 4% credit growth is enough to achieve our expected GDP growth of 1.5%. Right? So they are now, the central bank is targeting at least 4% credit growth to year, right? Instead of 12 to 13% growth. And also, but the central bank also want to set their target for 10% in 2021, and before in 2022, 23 maybe go to 12-13%. But at the moment, the central bank revises their private sector growth forecast for 4% credit growth, right? Okay, so these are some of the risk factors the country is facing. Right now, let's look at it, how we can de-risk the Sri Lankan economy. Now, how to meet those issues, right? Now, for de-risking the Sri Lankan economy, like any other countries across the globe, Sri Lanka also had some 3 main type of policies to handle this COVID-19. One is the border control. You know, border control means the people are not allowed to free move from country to country, and then health sector policies. So that is beyond our topic. Then they have the fiscal measures also, giving and controlling the price and things like that. And then the most important for us is the monetary and financial sector measures, right? Now, if you really look at the fiscal sector things, so government has given 5,000 cash grant, you know, reductions of dal prices and things like that, and insurance cover for certain people, you know, and allocating more money for testing purpose and all are fiscal areas. But we are not worried about that. We are just worried about the financial aspects. And this is the government, how much of money the government are injecting, right, to the economy. Now, if you really look at it, different countries have put different money to boost. You know, in US, you know, every person got $1,200 check and or something like that. And in Germany also given a lot of money. Other people also contributing to the economy. So these are the areas where the countries are given to boost the economy. And apart from that, and CBSL introduced series of short-term measures supporting banks. So we look at it, the CBSL introduced a series of short-term measures supporting banks. So about the capital and liquidity relief, operational reliefs, and some postponing some requirement. Now let's look at it. What are the regulatory support and directions um, given by central bank? Now the Sri Lanka central bank has reduced their policy rates, namely the standing deposit facility rate and the standing facility rate by 150 basis points, right, across the four cuts. Now, presently, during the March, April, and May, 150, right, and 2019, they started with uh, uh, SDR from 8 to 9%. Right now, 350 basis point will reduce from 2019 up to now, but out of that, 1.5 in fact was reduced uh, during this March, April, May. So even before this COVID-19, they have taken to reduce the SDFR and SLFR. So what is the objective of reducing this, right? And 350 from 2019. So if you really look at it, the policy rate comes down. So what do you mean by that? So we want to reduce basically the market lending rates. And I want to just to tell you something, and this is not only Sri Lanka has done it, there are some other countries also initiated similar things. Now, if you really look at it from the other countries' point of view, and policy rates cuts by almost 150 countries to safeguard the banking sector and safeguard the economy, right? Um, and also, if you really look at it, why we need to reduce our CBSL policy rates, basically to reduce the lending rates. Now, but they're telling we have been maintaining for the last 11 years the one-digit inflation. So then they said they want to bring that lending rate also to one-digit number, right? So you noted that because of these policy rates, market interest rates also coming down, right? And AWPR also declined by 8 basis points to 9.23 on 22nd May compared to the previous year, right? And if you look at it, lending rate also what they're expecting to reduce further decline. I mean, to expect it to decline further into single digits, right? That is the government expectation, and thereby giving boost to a credit growth in market. And support to that, and they have reduced their treasury bill rates and treasury bond rates as well, right? Okay, so and maintaining of open market operations and like that. So in the domestic money market, through these operations, and central bank in a position to manage their liquidity. So that's the second thing with this thing. And thirdly, and we had they have given some relaxation for NPL classification and impairment computation, and that's also some initiatives or some relief given to the banks. And also you noted the statutory reserve ratio on all rupee deposits liabilities of large and commercial banks was reduced by 1%. And mind you, and SRR also reduced last year March uh, from 6 to 5, and from this year March, from 16 March onwards, they have reduced another 1%. So now SRR is prevailing is around 4%. Now, as a result of that, so what is central bank is expecting to put 65 billion into the market that we can use for giving credits, right? And also the other important things, and central bank also reduced their bank rate, right? And they have reduced 500 basis point from 15 to 10%. That means why they reduced their bank rate. You know, the central bank, as the last resort, if you want have bank is facing a liquidity problem, they can go to the central bank with, of course, with securities. We can get a loan from them, and that loan is almost prime lending rates are come close to the bank rate. That means so the central banks are offering good interest rate, good rate uh, to the banks to maintain their liquidity. So these are some of the initiatives taken. And then apart from that, a lot of concessions and a lot of benefits is given to customers. Now, say from 6-month moratoriums, a lot of moratoriums are given. Right, moratoriums are, we all are aware, moratorium is not a waive off, it is an deferment, right? Right, we have to pay. Now, there are 6-month moratoriums given, period starting from April 2020, and then again the 3 months debt moratoriums given for all EMI loans and personal loans and leasing rentals and all, and they have identified different segments. And not only that, if you are not qualified for 6.3, so they are given 60-day period settle loans, 60-day moratorium. And apart from that, and all credit cards deferred, and if your credit card outstanding is less than 50,000, they have given lesser interest rate as well. And then the permanent overdraft facility was extended to September. And then in the case of temporary overdraft, and expiry date also extended by 2 months, but giving only a 13%. Now, apart from all of these things, that and central bank offering working capital loan to overdraft, or loan for especially for people to pay their employee salaries and all, for prepaid over 2 years at an interest rate of 4%. So all are support given by central bank for banks and financial institutions, and therefore wide range of debt moratorium has been announced for different identified sectors. For that, government has set aside, initiated the fund, or what you call that, refinancing facility, and initially they was given only 50 billion, and from 3rd June, and they were added another 100 billion, and now they are giving 150 billion to these schemes, and that means the bank can give more working capital loans at the rate of 4%, which are very eligible customers, of course. Will boost the economy as well as safeguard their customers. And also, central bank also introduce, or reducing rather, capital adequacy requirements and remove the capital conservation buffer by 100 basis point and 50 basis point respectively for banks with having significantly domestically significant important banks, and they have reduced 100 basis points, and other banks they have reduced 50 billion. Now you know the present um, way of calculated the capital adequacy ratio. So all banks in Sri Lanka put into two. One is basically for uh, significant domestically significant important banks, and they are given 12.5, and we had the three layers on that, three buckets on that. Domestic systematically important banks. Bucket 3, we don't have a bucket 3 at the moment, and bucket 2, that's of course the Bank of Ceylon and Commercial, and the bucket 1 we have HNB and People's Bank. And so reduce the rate by basically 1% and 1.5. All other banks who are maintaining 12.5% reduce another 0.5%. So as a result of that, because of releasing of capital conservation buffer, and banks now can release around 400 billion. So there's an adequate liquidity they can use for granting loans. So that's another initiative or other directions given by the central bank in this exit. And also, and we noted that in order to reduce the pressure on the balance of payment, and we have noted that we have a deficit of balance of payment, and because still the import is high and export is low, and accordingly directions was issued to the licensed banks to suspend the facilitation of importance of several categories now of motor vehicles and other non-essential items, and those are approved by the Trade and Tariff Policy Committee. Right. Now, so the LTV, the loan to value, so they have reduced from under new directions, and only three-wheelers given only 25, like that, they reduce the LTV. So that thereby they are trying to reduce the money outflow, right? Foreign exchange outflow. And they have identified four categories, and they say there are some items you cannot import at source. There are some essential goods items you can import. You can open LCs for that, and there may be some items you can import but requesting for 3 months deferred payments. And then the fourth category, so high duty. So thereby, or by taking these actions, basically government try to reduce the imports. Right. And from 20th April, central bank has given the directions. So maximum charge or maximum interest rate to be charged for pawning customers is 12%, right? And that's also because a lot of these days you have noted that so our pawning business will increase, and you see a lot of customers are waiting in the private sector pawning outlets. Banks pawning portfolio also gone up. So because people need some immediate cash. So in order to look after those people, and government reduced the pawning interest rate to 12%. And also central banks given deferring the requirement to enhance the minimum capital requirement by 2 years. Now there is some circular to be circular in respect to this, and to maintain 20 billion and 10 billion for foreign banks and 7.5 for specialized bank. So that requirement extended to 2022. So then again, we have some money to release to the market. And also, another measures taken by the central bank to restrict the capital flows through the suspensions of outward investment and also prohibitions of purchase of Sri Lankan sovereign bond by commercial bank. They said don't buy sovereign bond. And also the central bank introduced to get more money into the system, introduced a special deposit account and with some facilities given little uh, high interest rate than the normal interest rate, right? And also, mind you, the secretary to the president sent us in sort of a letter requesting all state banks, right, when you're granting loans, to focus more on micro and SME sector enterprise, and to be priority be given uh, uh, to small sector, but not to give the large loans. and they requested to average loan size to be around 25 million, and more working capital or business development be given to priority the all bank branches for creating of employment, right, and to pay more attention next three to 6 months. And also they were requested to get the maximum benefit from so-called refinancing scheme. And also and they were requested to discourage the large commercial loans and to concentrate on to give small loans, and also the meantime to maintain the improvement of quality credits and small loan size. And also they was requested all the banks to for remittances is coming from our people who are working abroad, to reduce their transaction cost. Such remittances could be waived, if can possible, to waive the period for 6 months. So not any charge cost for people who are going to send the money to their people here. And also requested recover the pledged loans given by the banks, especially for those maize collectors and rice mill owners, and thereby without creating manipulating the rice price. So central the secretary to the president is asked to pay attention to recover their pledged loans, right, and thereby get some money to the system. And also so they requested banks to come up with their lending policy, new strategies, and giving more priorities for SME, agriculture, and things like that. So banks was requested to send their lending policies to the people concerned to see what action the banks are take. So then from 2000 from May 13th onwards, and further directions was given by the central bank and to strengthening the liquidity positions of the banks. And one factor is to provide additional funding under refinancing first to the credit operation, right? And then and also to be considered as a liquid asset when computing SLR, SLAR. There are some assets to be considered as liquid assets, right? And thereby have enough liquidity in the market. And you know, the under Basel III, the new liquidity requirement also imposed by the central bank to be implemented from this year, So that is a liquidity coverage ratio and net stable funding ratio. Now, what is liquidity coverage ratio mean? Basically, the stock of high quality liquid assets is to be divided by net cash outflows for 30 days into hundreds. So it should be 100%, right? That means you need to have a more liquid assets cash with you, liquid assets with you. And then same like net stable funding ratio mean the money with you, a liquid form, to for 365 days. So these are the two new requirements, those liquidity coverage ratio and net stable funding ratio. Central banks earlier was requested all the banks to maintain 100%. Now they have requested or they have reduced their required ratio percentage from 100 to 90%. And also they have come up with another another directions or rather in communication to evade the liquidity through the SLDI system scheme. Now, what is that is a Sri Lanka Deposit Insurance and Liquidity Scheme. We had around 60 billion available funds under these schemes, where we will give for if the bank have some problems. so the scheme will facilitate to give that, but the finance are now going to get it from this scheme. But that money is up to 2019, somewhere in February or so, is around 60 billion. So we can give loans from that. So to maintain the liquidity requirement apart from bank policy rates, right? And also central bank has restricted certain discretionary payments to Malaysian bank, such including the declarations of cash dividends to shareholders and engaging share buybacks and increasing management allowances and payments to board of directors and senior management, and to cut down non-essential expenditure and more prudent with capital expenditure. Now, say the bank was requested to, especially the state banks, to cut down their advertising budget and not to spend money for so unwanted things. So these are some of the initiatives, so directions taken by central bank and the government to address this COVID-19, post-COVID-19 impacts. Right, a lot of initiatives have taken by central bank. Right, this is not only for Sri Lanka, but other countries also have initiated similar things. Right? Okay, now all are given to the banks. Now let's look at it. Other possible strategies and are suggested by various experts. Now I have gone through the experts' comments, our former governor, Mr. Cabral, and then PwC and some other countries and some other organization, research organization, who also come up with some strategies to address this COVID-19. Now, what one point is debt standstill. That means, now I told you Sri Lanka, we need to pay around 25.8 US billion during the next 5 years. At least 13 billion US dollar we need to pay as debt serving to respective donor countries or international lending institution. And so try to negotiate with them, as our president has already done to some extent, to stop at least for 2.5 billion. That's equal to 470 billion forex outflow because of as a debt payment, and which will stabilize the rupee, right? And then enable uninterrupted international trade and lead to normal economic activities. Otherwise what happened now, if you really look at it from the Sri Lanka rupee depreciation, and we had sometimes go to 200, right? Is 186 as from 29th May. But one time we had it around close to 200%. Now, how we reduce this to 200 rupee exchange rate? Because of releasing gross official reserves. So we had beginning of 7.6. Now we had around 7.2 because around 176 US dollars gross official reserves has to be released to maintain the further depreciations of foreign currency, right? So therefore, if the currency is going down, basically what happened? Uh, uh, what happened? The reserves has to be further deteriorated. But the depreciation is not only impact Sri Lanka, but in other countries also more than that. Now, if you figure, if you say 2.5, but others are going from more than that uh, with us, right? But these are the action proposed, strategies proposed. And then the second point, and to see the re-attract at least foreign direct investments, at least for 3 billion, which something comes to around 570 billion foreign investment to Sri Lanka. And then we can, we one time we had it such amount. Now at the moment is not much, around 1%. Now, this is not so easy task, easy target, attracting US dollars rupee, where and UNCTAD predicts around 15 to 15% drop in global FDI as well at the moment, because no any other country going to invest, because all countries are facing some problem. But that's another strategy in order to maintain the Sri Lankan money. So third point, the most important thing is the individual banks to look for short-term loan from a development finance institution, right? Third strategy, individual banks to look for short-term loan from a development finance institution. And that's a classic example. The Commercial Bank of Sri Lanka obtained US dollars 50 million from short-term loan from IFC. Now it's which come to around approximately 100 billion, and to support COVID-19 affected SME exporters. Based on their credit capabilities and basing their strengths and some initiatives, and commercial banks in a position to obtain that short-term loan facility. So bank also can request from certain development finance institutions, some which facilitate the government, right? Okay, so why not other banks? Then the fourth one is a very important things introduced by what this former governors talk about, releasing of 20% of EPF member balances to the members, right? So that approximately, now what is our large large superannuation fund, we had around 2.3 trillion EPF balances, to release 20% to all the EPF members of 2.6 million. Now, and so the moment you release such a big amount, remember, and only amount 500 billion release. If you look at from the 2,500 billion of approximately our superannuation fund, 20% is around 500 billion. And then, so we're giving to the customers, and customers make use of that money to pay their dues, pay their salaries, and then again, the economy, it's from to the economy and stimulates the economy, and also good for banks. So I mean that's a suggestion made by former governor, and that already implemented in Australia and India. That's some similar system, right? So these are some of the other initiatives, right? Okay, then the PwC, they also come up with to granting measures for economic recovery process. They have identified two type of funds initiatives called fund-based initiatives and taxo grant-based initiatives. They are also proposed. Now, what do you mean by fund-based initiatives? Mean enable enterprises to strengthen the cash flow and liquidity position in the short-term medium. They were basically suggesting two main initiatives. So one is enterprise financing facility. Now, what is the objective of this? Large corporates which have a strong credit history but experience a liquidity pressure due to the COVID, they can introduce short-term financial papers like commercial papers. Now in Sri Lanka, we don't have a big market for commercial paper, a short-term money market instrument, and what they are requesting, and those are tax deductible and tax free, and give some large organization to issue treasury commercial paper with the concessions, and whereby they can sort out their own liquidity problem. And then the second type of things they suggested is business disrupting funding schemes. And there is a temporary measure to issue for all these problems to interest cost incurred by corporates to be waived off for 2 months. Right? So, but they are suggesting. And the next one, the sixth strategy, apart from all these government relief initiatives, now the real estates is a key form of collateral for banks and other economic activity. So we take collateral as real estate. And so it's very difficult for easily liquidate under these circumstances, and was requested to eliminating stamp duty and other charges associated with transactions. So therefore, can be revalued next to 3 years, particularly in the hotel sector. They can take a loan by thereby reducing the cost of credit. Right. The seventh point is the Export Development Fund, and this is people are talking. This was initiated, and this was very famous in Bangladesh, where all exporters are entitled to obtain facility of up to US $25 million for procurement of raw materials. So bank can open LC to the value of 25 million, and that is based on the pending order, right? So if you can come up with this sort of a facility to the exporters, and thereby they may also come out from this bad time. So these are the some of the 7 strategies which I have gathered from different research papers and different experts' opinion. We can make use of to complement the debt moratoriums and other other loans offered by affected sectors, right? So which are basically need a longer term support, right? So apart from with this reliefs package, and with these new strategies, and we think the economy is going to be benefited because of the economy is doing well, and credit also going to increase, and then the banks also had a good note. Right. So if you summarize all these things, a lot of actions have taken by the central bank and government to address this COVID-19 effects. Right now, so we look at it, impact on banks. Now, how all these factors impact on banks. Right now, how COVID-19 impact on banks as far as the credit is concerned, right? Okay. Now that's the important area. So we're discussing more greater length. That's what we want, right? How this COVID impact on COVID-19 impact on credit business and also the bank. Right. First point is the profitability. Now, these the major short-term impact of COVID-19 on the retail and commercial banking industry, and will be revenue compressions from multiple sources, right? And due to difficult operating conditions, and also the performance of the banking sector, and especially for NBFI, that's non-bank financial institution in particular, will be more challenging and affects asset quality and profitability recovery. Right now, if you really look at it, of these introductions of debt moratorium may reduce this stress on businesses that causes a barrier for banks. Now, if you really look at it, when you calculated the loss, I mean, of course, loss, some people can say the loss it's a national duty, is a common to every bank. So every bank has to face this problem. But what is the loss of these moratoriums to the banks? And banks are now calculating rough estimation for the loss because of this these moratoriums and other relief facilities. So banks, according to some information, maybe one major large bank in Sri Lanka, big bank, may be estimated around 6 billion. Some banks are estimated around 2 billion, like so overall around 50 billion may be impacted to their profitability, right? But somebody can say, okay, that is what the government, before this corona happened, they have reduced they have withdrawn that defense levy for 7%, and nation building for trust tax also 2% reduced, and reduced the corporate tax to 24%, and that will give you a lot of recovery for these concessions. But mind you, this was happening before COVID-19, right? So, but still, there are a lot of calculation is going on, and as told you, the moratorium is not a waive off; it is a deferral. So, therefore, still banks need to charge certain interest, and the central banks have sent their last week they have sent the instructions to give around 7% charge for the interest, and then based on that also banks have to incur a little bit of cost, maybe cost impact the profitability of the banks. Maybe if you really look at it from the credit market in Sri Lanka is around banks has given around 9 trillion. So out of some banks is 70% request ask for the moratoriums, and then it's also a huge amount, right? And BOC is around 1.6 credit given, people span 1.3 and HNB around 800 billion, commercial also 900 odds, and then some have also 700, NSB 400 odd. So these are the portfolio banks, and maybe around 50-60% of that maybe was requesting for these relief facilities. So therefore, cost or the loss or impact for profitabilities seem to be a little high. Right. Then when you move into the increasing of NPL, and there's a possibility of increasing the NPL. That's another important factor of banks. Now, after the 6-month debt moratoriums and other measures imposed by the government, and expected to soften the impact of individuals, but may increase the non-performing loans in 2020. Now, the classic example from loans given to migrant workers. A lot of migrant workers who are working in especially the Middle East and all other countries lost their job, maybe pay cuts, so they may move into Sri Lanka, and then there may be a possibility of the loans given to migrant workers by the banks may not going to get the loan installments. There may be a possibility of increasing NPL. Right, and if you really look at it, and it's going like this, and resulting the fresh asset quality is a problem, right? Because of NPL, and increasing the NPL is not a phenomenon because of COVID-19. And to really look at it from 2019, and that was increased to 4.7 by the banking sector from 3.4% rise in 2018. And also important thing is the non-bank financial sector, and NP ratio is almost 10%, 10.5% in 10.6% in 2019, and banks also NPL is high. So because of this pandemic situation, and the NPL may go. The moment the NPL is going up, what happened, right? And it is estimated that is around 7.2% in the industry, banks as well. So the moment the NPL is going up, so we have to have a adequate provisioning, right? And if you really look at it, some of the NPL ratio of major players in Sri Lanka, some are good, some are not bad, but then some banks, when you compare with 2016 to 2019, the NPL ratio of the banks is going down, even though the industry rates is something 4.6. And after this happened, there will be a high NPL. Then the provisioning has to be increased, impairment also taken care of, but anyhow, bank has to pay it. So NPL is going to go up. So that's showing the poor credit quality. Then that's the second factor, how impact the profitability and then impact the NPL. So then, and also a pressure on NIM. Now, so we noted that we want to bring that 1-digit number lending rates, and then there may be definitely a net interest margin is going to come down. Now one fact is good for banks as far as the credit is concerned, giving a 1-digit number lending rate. But how about people who are living with their funds? I mean, their pension funds and things like that, living on the bank deposit interest rates. One sector is going to be really impact on that, even though the credit is booming, right? So there will be a lot of pressure on NIM, so net interest margin is going to come down further, right? And the fourth factor is what you call fee-based income. Now, fee-based income, and due to low remittances and loans, due to remittances and loans. Now, all financial institutions have been told not to charge check returns, stop payments, late payment fees, penal rates, and all sorts of things. Ultimately, reduce their fee-based income. Right, that's also correct. And transaction cost was requested to waive off period of 6 months. Right, and mind you, if you really look at the workers' remittances, um, is basically expected to forecasted to be reduced to 5.4 billion in 19% from 6.7 we had it in 2019. And the world remittance market, what is the total world remittance market, is something called 714 US dollars billion. Now, if you really look at it from the world remittance market and take into account the Sri Lankan remittance market of 6.7, so we are gathering only 1% of the world market. So 1% drop, but that's also going to drop by 19%. That was estimated to 5.4. Now, as a result of that, remittances further comes down. The fee-based income is going to come back again. And Sri Lanka is around 1.7 migrant workers and 5 million beneficiaries are living on that. So the fee-based income, because of reduction in remittances, also going to impact the banks. So that is the area. And also, and loans, fee-based income due to remittance and loans also maybe have some issues because we have not have a problem with recovering of loans. Right. Now, if you really look at it, these figures, how these majority of remittances are coming from 81% remittance are coming from banks. So banks remittance fee-based income, they are going to impact. And the fifth point I'm going to discuss with you about the impact of this pandemic is indirect advances. Now, you see the decrease in off-balance sheet exposure was reported in 2019, right? And it further down, reflecting of slowdown of business activities. And that's going to take place during the year. Now, direction also issued by to the licensed banks to suspend facilitation of importations of several categories of motor vehicles and certain essentials items under Trade and Tariff Policy Committee. So as a result of that, our opening of LCs going to come down. Right, that is another fee-based income as well as form of guarantees and LCs and all. So our indirect advances also going to impact. Right, and the sixth point, increase in the credit cost. Now you see the challenge for many banks will be how to operationalize these programs. Now we have a lot of calculations to be done, and mind you, some banks have some some programs, only 1 or 2 people are aware about these programs running, deducting of installment, and once the government say they run the standing orders and deduct all the installment, and once you told them to release that installments, and then again they work it again and put it to the account, and then very next month, once the money comes and it is deducted from all the installment in their next month's salary, and then again they have charged the penal interest rate on that, and they have to revise all these things, all these things. And we don't have a experience. In fact, we have some experience after Easter Sunday attack, a similar moratorium modifications, but still our core banking or our loan accounting system we have not flexible enough in that scale. So therefore, a lot of work has to be done, a lot of correction need to be done, and a lot of people need to work, and therefore, definitely the uh, cost, credit cost, going to go up. A lot of operational complexity is high, adjusting. So therefore, so a lot of administrative cost and working from on that maybe your credit cost going to go up. Is impact the cost structure of the bank. And then, so the another important factor is new attacks. Now, while banks are providing more flexible customer access, and a lot of uh, people are working at home and give access to employees to work at home, and that's a good sign. But then, so there may be a more chances to be hacked by those people. The cyber security, and also customers' sensitive information may flowing outside the organization, and it shall be managed appropriately. So that's the impact for banks. And uh, when I talk to some of the leading banks in Sri Lanka, so only few people know how to dealing with all these adjustments in the IT systems. Not all can do. Only few people can do. Then there may be a mistake. There may be a fraud can take place because of this. So there may, as a result of this, the reputation risk and then frauds can be taken place. So that's the impact for banks, right? Because of working at home. Right, and also we was asked to pay all the payments to the internet banking. So there may be a potential cyber attacks can take in place, and already something happened in Ramza. So collecting some information. So there may be a potential threat. So then up to now we always look at the bad side of the COVID-19. So there may be a positive side also, and also we have to remember customer banker relationship in terms of marketing point of view. So the banks and financial institution purely based on customers trust and confidence. Now this is an ideal time for customers also to see whether to what extent your banks are look after them, right? And so this is an ideal time for bank to build up stronger, enduring trust-based relationship with the customers to compete with your competitor. And and while a changing situation, and it's an opportunity for banks to show that they understand their customers right, because the customers had a bad time. So we are there not to get the maximum out of them. Then we have to wait. We have to be there at the bad time. So and committed to supporting them through the crisis. Now this is an ideal opportunity for banks to build up healthy relationship. Why? Because clients will remember for a long time how they are treated during them for next 6 months. So are they going behind, not giving any facility, not giving any concession, so they look at it. So therefore, banks need to give very careful consideration to their approach to credit resolution, right? So it's an ideal time for banks to build up customers, an ideal time to look at customers to think of their banks with they are dealing, whether they are really look me and I'm at the bad food, right? Okay, that's an opportunity, right, in the future, because if you done wrong thing, so customer may remember with you, remembering all these things, right? The ninth point, another impact on banks is an operational issues. Now, inability of the existing rating models, application rating, and to capture the effect of COVID-19. Now, whether this existing model maybe not geared to access the impact of this magnitude. Now, this moratorium may maybe not definitely impact your credit score, but still our rating model is going to address. We have to relook at it. And then, so existing stress testing scenarios used to access the credit risk test, maybe not capable enough of capturing this pandemic. And also, banks need to look at it, closely monitor the funding and the recovery plan of the banks. So there's some operational issues, some operational areas banks need to consider. And then there may be a liquidity issues also. Now, financial sector liquidity so will be impacted by the debt moratoriums, right? So although offset to some extent by the reductions in liquidity requirements for financial institutions, but there's a need to detect worsening liquidity position of the banks, right? And it may be adversely affect their liquidity, right? And also, so we have to do a lot of stress testing. Banks also be a relevance and importance as we run certain events, right? So we have to strengthen our stress testing, right? And then another 11 point I will talk on. So we have to look at it with different lenses. Now, one thing is borrower by borrower approach. So that means, so just because of having all these facilities, all these relief packages may not necessary for everybody. Because the moment you give relief packages, the customer at a bad food, because we may charge the rates at end of the period, end of the agreed period. But we have to look at it by case, borrow by borrow, right? And thereby we look at the sectorial modeling and also individual customer cash flow modeling. So we need to look at it that's rather than going across the board approach, right? And then we also going to look at it cash flow based lending into asset based lending. Now, sometimes getting intervention and messaging right, bank also need to proactively consider alternative lending structures, right, to convert their cash flow based lending into asset based lending. If you can convert their cash flow, right? Now, good example, one person is quoted with struggling restaurant, maybe household house in a family property, right, that has been on for generations. So now might be the time to consider commercial mortgage to create cash reserves, right? We see from converting asset cash flow to asset base, right? It's a new way of you can look at it. Then another important point I want to highlight here is the positive side of the banks. Now, people become cutting edge. Now, when you're preparing our what you call mission statement, we put the word technology as a cutting edge. But why we not putting people now become a cutting edge factor? That is Forbes talk about this, and people becomes cutting edge factor and become accelerator for one of the greatest workplace to transform your workforce from rowing to rafting world. So what do you mean by rowing to rafting world? Now, the important thing is now, because of this impact, all banks employees to be act as to play a professional role and becoming an increasing strategy. Now, the employees need to take pause, flexible, focus on the spot decisions, right? And in this respect, 10 C's of employees engagement play an important role. right? Now, say for what is this is behavioral organization behavior. One doctor suggested 10 C's. Now, what is 10 C's? Is connect, uh, career, or career mean upskills or modify your skill knowledge, and then the clarity, then regulation, and then the contributes, contact, control, collaborations, credibility, confidence, all matters contributing to this because of this new environment. People work at home, and their decision making power need to be increased. That is why I call now people can be used to become cutting edge factor and shift from rowing to rafting. Right. So that's a positive sides of that. And then we talk about a merging and acquisition. And based on the PwC Global COVID-19 CFO survey and the impact of outbreak on mergers and acquisition strategies remain unclear at the moment. Now, they said around 13% report uh, an increasing appetite for merging and acquisition. Now, why I'm saying some the organization cannot cope up with this time, with this adverse situation. There are some people in the same industry can go and acquire. They are competitive, right? There may be an opportunity for big players to, the guy who is not in a position to cope up with this scenario can make and go and take over. And also then the banks have an opportunity for leverage buyout. So that means using credits to buy the um, institution, right? There's an opportunity, right, in that aspects. And if you really look at it from the another area is a certain um, drawdown is expected to increase the lending capacity of the banks. That is one of the objective of all the relief measures. No, now can you remember the reductions of statutory reserve ratio from 5 to 4% from 20 from March? Central bank has reduced their ratio SRR from 5 to 4%. As a result of that, 65 billions are available banks to give us credits, right? And then thereby injecting 65 billion. And then lower capital conservation buffers requirements and differing the requirements to enhance the minimum capital requirements by 2 years all contribute maybe around 400 billion. So huge money available because of this with the bank, and thereby increasing the lending capacity of the bank, right? That's the positive side. And then if you look at it, another point, if you really look at it, the more digital savvy customers, so thereby reductions of operating cost. Now, banks can review this positively and digitalize most of their credit operations to ensure internal efficiency and external effectiveness through customer-centric enablers. So this is an ideal opportunity for banks to concentrate on people who have not basically IT driven or digital environment. So they're compelled to work under this scenario, under this obtain this facility because of there's no option, right? And bankers face high usually internal cost and acquisition cost, and then digitalization can reduce this cost, and thereby they can relook at it, their cost structure, because it's an good time for people to go um, introduce a lot of digital transaction operations. Thereby, they can reduce their operational cost. And another point we need to look at it and impact on banks, the positive side, and the government also look at it because of the downturn trend of uh, impacted on to the world. There may be opportunity for us to concentrate more on agricultural um, purposes. So banks having an opportunity for granting more loans for agriculture. So banks are not willing to give more loan for agriculture because of the sensitiveness of the type of loans, which is subject to a lot of bad weather conditions and things. But then they have identified so loans can be given to especially for poultry farmers. Right now, according to the agriculture department information, um, so our base annual requirement is around 3 million metric tons. 70,000 acres are cultivating. And so requirement for poultry business is around 60,000 metric tons, 600,000 metric tons to 400,000 metric tons. Right. For that mean, so bank can consider develop a special loan scheme for this segment. Right. Okay. Right. Next point, and also another important area. So banks can look at it, new business segments to give loans. Now, one important factor in the long term, the government may be focused on development of health-related infrastructure can give rise to newer lending opportunities. Right in the future, there may be government may be looking after more health-related infrastructure projects, and banks can consider to give a more loans on that side. Second area is e-commerce business. Now, what is e-commerce? You know, in the world, there are around 3.5 trillion market, US dollars 3.5 trillion market for e-commerce business. But in Sri Lanka is around 85 to 90 million rupees. So it's a very small amount, small percentage, right? So Sri Lanka had around 6.4%, so sorry, 6.4 million social media users, and our mobile penetration is around 140%. So why banks not give people who are interested to develop this business? Now, one of the difficulties of these institutions are facing, or bank companies are facing, the startup cost, right? So bank can consider in that area. And I saw an article saying that Vietnam is spending around huge amount of money to build up e-commerce business in 2025, right? around 35 billion or something, right? So banks also can consider giving loans to this area, right? Now these are some of the areas, the impacts on banks of this uh, because of this COVID-19, especially with respect to credit. So there are some positives impact as well as some negative impacts. So uh, this relief, so this pandemic may be an opportunity for banks as well as some threats to the banks. So, so that is what I want to discuss with you under this topic. So up to now, for the last couple of weeks or 3 weeks or so, we discuss credit environment and we analyze, just to summarize what we have learned last 3 weeks under the Advanced Diploma in Credit Management program. But this, what was first we discussed, give little introductions to the credit environment, the credit business, why we need to know about the credit business, the problem faced by the managers, bringing your present credit portfolio income to other areas. And then we discuss the internal competitions faced by use of Michael Porter concept. And then after that, we discuss the credit industry, who are the key players, and what are their portfolios, and things like that. And then we discuss the fiscal factors, how economy impact pre-COVID-19 for credit business, how social cultural factors, how legal factors, then ecological factors, and then ethical factors, and then we discuss about the technology, how these factors impact the credit business. And finally today, so we have discussed post-COVID-19, how this post-COVID-19 impact the credit business and through banks. So what are the positive impacts and what are the negative impacts? What are the initiatives taken by the government as relief package, and some strategies suggested by various experts apart from this relief package, and how banks will take care of all these factors. And I hope I have done something which is not a textbook thing. It is on the practical aspects under Advanced Diploma in Credit Management, the subject called Credit Industry and the Environment. Right. So if you have any problem, so you can want to clarify something, you can just switch on your mics and ask from me. So maybe next week, maybe another lecture comes to address the other part of this side. There may be one question from this area as well in your exam paper at the time when you're going to have the exam. If you have any things to clarify, you can just raise from me. I don't know whether you understood or not. Some people have joined from the very first day, but still you can, this first program is recorded and you can listen to our previous discussions on the other topics. So any more questions to be asked? Oh, I don't know whether you understood or not. Any comments? No, as usual, no? Right. Okay, just thank you very much for joining with me for the last 3 weeks. And I hope I have done something for you just to think. Most of you are bank employees, and mind you, and look after your banks and look after your health, and the institutions find solutions support the business and support the economy. Thank you very much.